This is frightening. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, Target just issued a major warning to the entire U.S. economy. I'm going to show you what Target is warning about and why what's happening at Target is going to affect every retailer all across the country. But more importantly, I'm going to show you why what's happening at Target, despite the claims of the political elites, indicates that the U.S. economy is in the early stages of recession. Plus, we have a shocking government report that reveals the true state of the U.S. economy. I'm going to show you why the government knows we're in a downward spiral and that nothing could change the trajectory of the U.S. economy. Now, let's head over to Bloomberg, where he picked today's story up with a headline, as Target shares tumble after retailer cuts profit outlook as the company stockpiled merchandise ahead of the U.S. port strike. But the real issue here isn't what the headline suggests. What we now know is demand is crumbling, and this is different than what we just heard from Walmart, because what's happening in Walmart is people are trading down to the big retailer, while the issue is for retailers like Target, prices are too high and consumers are saying we can't afford it. Company executives said U.S. consumers spent less on non-essential items such as clothes and home products, a weaker third quarter picture than previously provided by Walmart earlier this week. And we start to look at other retailers that have high prices compared to Walmart, and you can only expect, as we continue to get earnings reports in, that what we're going to see from U.S. consumers is continued declines in demand and foot traffic and spending, because what it's indicating is that incomes growth is too slow, the economy is too weak, and there's issues with the labor market such that consumers now cannot afford to spend money like they used to. And profit also took a hit after the company stockpiled more products in preparation for the U.S. port strike last month. Holding the additional inventory was more expensive than the company expected, eroding earnings and adding to cost at a time when really competition is heating up from companies like Walmart, who are trying to drive prices lower to gain market share, which is an issue. You're going to see retailer after retailer now start to express the same concerns that Target is, and what this is a broad indication that the economy isn't experiencing a soft landing or no landing scenario. What it suggests is we're about to take another leg down. Weak results at Target underscores how big part of Walmart's strength is in market share gains. The consumer may be, quote, resilient, but they're still discerning and promiscuous. The poor Target performance probably doesn't bode well for the likes of Kohl's, Dollar General, and Dollar Tree, and you can add just about every other retailer in this country, because right now what you're seeing is companies compete for the limited amount of money that consumers have to spend, and right now consumers are saying we're going to look for bargains, we're going to try to save money, and that means we're going to be cutting our discretionary spending, because we know the economy is weakening, the labor market isn't as strong as the government suggests, and savings rates for many Americans are very, very low, meaning they've got to save money. And right now, when we're looking for a turnaround in the economy, what Target is telling us is no, it's about to get worse. And the evidence is very clear as we look at real retail sales, shown in blue, against total incomes in red, which is a function of average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. And when we see these on a year-over-year rate of change, it's very evident that as income growth slows, well, that means workers have less money to spend in the economy. And sure enough, what do we see here between 1994 and 1996 is that real retail sales start to slow. And again, that happens going into the dot-com bubble. We start to see retail sales peak, but what happens is income growth starts to peak as well. And as it slows down, well, that means, of course, workers cannot afford higher prices. They start spending less, and we go right into a recession, which is exactly what we saw going into the global financial crisis. After a big long trend in rising incomes, we see incomes peaked, start to slow down, and that immediately impacts retail sales, because what happens here is you see, again, prices were going up due to inflation, but incomes were not rising fast enough. And we're seeing that trend happen once again now. Starting in 2022, we see a big deceleration in incomes as government stimulus starts to go away. And what happens? Retail sales plummet and then are largely negative for now almost 3 years. And what Target is saying is, as we hope that things are going to turn around. Remember last quarter, Target and other companies said, we finally see some green shoots. We see consumers coming out and spend, and we said, hang tight. It's probably just an anomaly. And sure enough, it was. We're now seeing, of course, the downward trend. as Target's chief executive tried to downplay the negative results in a call with reporters, noting that issues like the port strike were a one-time problem and the company's early read on holiday sales were positive. And why are they downplaying this? Because for several quarters now, what have we heard? That's all about the election, that the reason consumers aren't spending is due to election uncertainty. They just need to know who's going to be the next president, and that means once they know, they're going to come out and spend. And what Target's saying is, wait a minute, that wasn't the truth at all. We're seeing less foot traffic, we're seeing less spend, and that's exactly what we said would happen. It's not about the election, it's about paychecks. In this case, paycheck growth is shrinking, and that means against rising consumer prices, spending has to go down. He said the company is working to respond to weak demand. There's a clear issue. It wasn't about the election, it was all about demand and offset higher costs. So you see the issue here. It's all about inflation and incomes. The reality is incomes were not rising as fast as inflation. So while everyone's worried about higher prices, the real issue was their incomes were not growing fast enough to cover it. Now we see Target admitting the truth, but it made the right decision to stockpile goods ahead of the port strike just in case it went longer than expected. Now the risk is the cost for Target's goods are now higher than its competitors. But if you're looking to make a change in your income in this economy, let me show you how I do it. I'm going to show you I trade. You want to trade right alongside me? You want to know what trades I'm doing, when I'm doing, what I'm looking at? Well, you can follow right along, because where I start is I like to look at machine positioning, and I love to find when positions are in deep short positions, because when price reverses against it, well, that means the machines have to come in and buy and boost the price of it. So that's the first place I look for my trades, and that's where a lot of my trades originate. But I also look to momentum trading, and that means I've got my Momentum Timer Pro, because I look at momentum over long periods of time, over 1, 3, and 6 month periods. And what I look for is deep pullbacks in momentum, because that's what traders are looking for. They're looking for oversold conditions, and as momentum turns up, they come in and buy, and I want to be buying ahead of them, and that's the edge we have. But one of the best things about our reports is we back tested all the signals across everything, so we know the high probability signals that are going to potentially generate a 50% more chance of a positive return. And we give you those reports every day. You get the daily reports, the tradable signals. You get my opinion on which trades I think are the best and my actual trades. Full backtest data is given to you, stop loss levels, complete tracking of trades and return, a weekly update on all the trades. Here's the best part. You want to know what I'm trading, you want to follow along with our duplicatable system, you get the 30-day free trial. Links in the description below. Join us and start making some money, because consumers are going to need to make money, because you see the effects on this chart of higher prices against slowing income growth. Now we're taking income growth and overlaying the consumer price index in blue, and you can see what happens at Target. Is the issue is you go back even to the 70s, you see rising consumer prices, but what's happening, income growth is rising until income growth starts to peak and slow down, and what happens, you get a recession. You see that happen right around the mid 70s, and again going into the 80s. The issue was incomes were not keeping pace with inflation, and we see that relationship repeat over and over. And right now, while we're seeing inflation coming down, income growth is still not keeping up with it, because it's only part of the issue here. We know the labor market is far weaker than the government wants to admit, and wait till you see this shocking report, because it's going to reveal the truth about what's really going on and why the odds of the U.S. economy turning upwards is extremely low. It's disappointing that a deceleration in discretionary demand combined with some cost pressures have caused us to take our guidance back down after raising it last quarter. So remember, last quarter, everyone was getting excited. They say, hey, look, as soon as the election's over, consumers are going to come out and spend big. And we said, wait a minute, that's not likely to happen, because there's a couple factors here. Income growth is slowing, delinquency rates are rising, and banks are tightening lending standards, so consumers don't have access to credit. They're already in delinquency, and their income growth is not keeping up with inflation. This is not a recipe for come out and spend. What it's a recipe for is tightening your belt. And we believe it's prudent to take this conservative approach. Well, you better believe it, because the next approach Target's going to take is cutting hours to its employees and laying people off. Because again, it's all about the labor market. It's not just about incomes, but that's only one side of it. It's about the total labor market, because as people lose their job, well, they naturally spend less. That's exactly what's affecting companies like Target, and retailers all across the country, as we now see real retail sales still in blue against the unemployment rate. And it makes sense, as people get on the unemployment line and they can't find another job, their incomes go down and they still have to spend money on rent and energy and food. And we know costs for those things have gone up. We know debt service costs are high, and that means they have to cut their spending. And this means on the discretionary side. So when you look around, as we see earnings come in here over the next couple weeks, and we look at these discretionary retailers, what I expect to see is a big plunge in demand. And that's one reason we're seeing people trade down to companies like Walmart, because they're trying to save a buck, because right now everything matters. And the results may renew investor concern after Target succeeded in ending a streak of negative sales in the previous quarter, suggesting a recovery was in the works. And this all it was, the suggestion that the U.S. economy was now in the stage of recovery. The reality is economic data and demand doesn't go down in a straight line. There's going to be some bumps along the road. We saw that in the third quarter. Now we're clearly headed in a downward direction. Target posted a string of weak results amid high interest rates and inflation before showing some success in boosting sales and traffic in the second quarter by offering deals. And that's the key thing. They offered deals. They had to bring prices down, because when consumers can't afford higher prices, yet people still believe that you can get rising inflation. Well, you can for a little bit, but if consumers are not buying things and you see goods sitting on shelves, retailers will be forced to cut prices. That's exactly what Target did, and it worked. But the problem is they need to cut more because income growth is slowing. So you see it all comes back to the labor market, and now you see why companies like TJ Maxx, discount retailers, they're saying, hey, our earnings went up on higher shopper visits, because what we're seeing is consumers still need things, but they can't afford high prices. They're looking to bargain shop, and that's good news for TJ Maxx. Bad news for companies like Target and other retailers, as customer transactions drove our comp sale increases. Is from the CEO, who's highlighting the appeal of the treasure hunt shopping experience to a variety of customers. The fourth quarter is off to a strong start. Well, I can tell you this, customers aren't excited about treasure hunting. What they are excited about is saving money. And if you got to go to TJ Maxx to save money, people will absolutely do that. But you can see the problems here are extending outside the U.S. as we turn to Germany. And what we see is Ford now plans 4,000 job cuts in Europe as EVs lose momentum. When we talk about the German manufacturing sector being in a depression, the only people who don't believe it are the political elites in the European Union. But soon they're going to find out the demand there is so bad, it's going to drive the German economy and the rest of the Eurozone down with it. The job cuts mark yet another setback to Germany's struggling industrial base, as last week the Council of Economic Experts, there's a key word, is experts, that advises the government scrapped its forecast for economic growth in 2024 to predict a second year of contraction, followed by just a 0.4 expansion in 2025. Well, I'm not going to bet too big on that positive expansion next year. As far as I'm concerned, it's going to be negative, because the reality is when your manufacturing base is in a depression and you continue to see more layoffs stacking up, what it means is the services sector is going to follow with a lag. That means Germany's economy isn't just in a recession, it's headed right toward a depression. They're going to pull down the entire Eurozone with it. But let's talk about that shocking government report, because it reveals the true state of the economy and why it's highly unlikely we're going to see a turnaround in the direction of where the economy is going. As credit is now harder to access as rejection rates rise, as according to a recent Fed survey. Despite largely stable demand, applications for various forms of credit were increasingly rejected in 2024, according to the Federal Reserve Bank of New York. Americans also became more pessimistic about their ability to tap credit in the future. So we come back to what's happening at Target, and it starts to make perfect sense, because we're in a debt-based economy, which means the economy expands as new debt is created and spent out in the economy. So if consumers cannot access credit, it means they can't buy things they don't need with money they don't have. They have to buy things they do need with the only money they have, and that's why we're seeing a big reduction in demand. So while many people, including Target, are hoping to see a turnaround, as long as the banks aren't lending, the probabilities of we seeing a soft landing or no landing scenario, or perhaps a return to a growth track starting next year, is highly unlikely. What it suggests if we're going to continue our downward slide into a recession. Reported rejection rates for credit cards, mortgages, auto loans, credit card limit extension applications, and mortgage loan refinance applications all rose in 2024. So what happened is consumers said, look, we need more credit, and it makes perfect sense. As money gets tight and we see financial conditions tight and there's less money in the economy, what happens is people need access to it. They turn to the banks and they say, look, I need some money. And the banks are saying, look, we don't think you can pay it back. And that's why they're getting rejected. The findings show reported rejection rates rose to 21% this year from 20.1% in 2023, well above the 17.6% average seen before the pandemic. Borrowers with credit scores under 680 were especially likely to face rejection rates that were well above pre-pandemic levels. Meaning, as consumers are faced with less access to the credit markets, not only is there less money being created and injected into the economy, it means what's facing U.S. consumers is they're going to have to only spend the money they have. We know they don't have much of it, and that's why Target is screaming here. They're saying, look, we're headed in the wrong direction. We're seeing a big decline in discretionary demand, and it makes perfect sense because without access to credit, consumers are very limited. And we can see why the banks are constricting the creation of credit. When we take a look at the net percentage of domestic banks tightening stands for credit card loans in blue, and when they're tightening, it's anytime the blue line is above that horizontal black line. And we're going to look at this against the delinquency rate. And here you can go back to the mid-90s, and what do you see? Delinquency rates are rising amid tight banking standards, and that makes perfect sense because when consumers get behind, maybe they're not getting as many hours at their job, maybe they've lost their job, or something about their household finances have changed, and they need money to bridge and get by because they believe the economy is going to turn around. Well, they go to the banks and try to access the credit markets. They get rejected, and that means, of course, they don't have enough money to pay on their loans. They go into delinquency and eventually into default. You see that happen again going into the global financial crisis. The banks start tightening lending standards. What happens? Delinquency rates rise. And again, this is all about the idea, the concept. It's about musical chairs effect with money because there isn't enough money to pay on all the debts. So when the music stops, what happens is there's a lot of people that need money and not enough money in the system for them. And so that means some people are forced to go into delinquency. And here we can see that now. Banks are tightening standards. Consumers are saying, look, we're getting rejected for credit. That means delinquency rates are likely to go higher, and as well as demand for retail goods. The average rejection rate for mortgage applications increased by 8.6 percentage points to 20.7 in 2024, more than double the 2019 rate. So what's happening now is consumers say, look, you won't loan me money in any other place. Well, I've got equity. Why don't you give me that? And the banks are saying, look, you can't have it because we know you can't make the higher payment. And that is a huge problem for mortgage refinances. The average rejection rate rose to a series high of 25.6%. For auto loans, it rose to 11.4%, the highest since the start of the series in 2013. And borrowers don't expect it to become easier to obtain credit in the near term, and fewer people are planning to apply for loans over the next year. And that is dangerous because as consumers demand less credit, what it means is less money injected in the economy, less money to spend on goods and services. You can see it's a foregone conclusion. The government knows we're headed into recession. And yet, what is the Fed's response? Well, we're not sure. We're going to cut rates. But we can see demand declining, not just in the U.S., not just in Germany, but all over the world. And we see it in the energy markets as oil steadies as traders weigh war risk against stockpile gain. The real risk is that stockpile gain. And here we can see oil later weakened after the Energy Information Administration said U.S. crude stockpiles rose 545,000 barrels. But the big one is gasoline inventories rose by 2.05 million barrels. What's happening here is consumers run out of money. Well, that means not only do they spend less, but they also drive less. And the International Energy Agency has warned that global oil markets face a sizable surplus next year, even if the OPEC Plus alliance doesn't bring back curtailed production amid faltering demand growth in China. Well, the story's not just about China, it's about Germany and the U.S. consumer. And based on everything we're seeing, we're in the early stages of a global recession, with some parts likely to hit a depression. The only question is, can we see a turnaround and fast enough? Right now, it doesn't appear that anything could change. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.